Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, November 18th, 2020, and I am pre-recording this Trading Places Live for Thursday, November 19th. Futures are slightly lower, pretty close to the flat line. The Dow Jones last few days trying to get through 30,000 has failed, pulled back pretty substantially. Today. We're going to go through those numbers in just a minute, but we did back off that 30,000 level, which is not too shocking. It is a psychological level. I think once we get through it, I think the market's really going to move. I think we can get through 30,000 and quickly get to 31, maybe even 32,000 on the Dow. That's what I'm expecting. But pausing here, especially going into option expiration Friday and the week after, that's not a big shocker at all. But again, we'll get into that in just a minute. The agenda for today. We're going to go through the daily market recap as always. Then we'll get into talking technically. I want to talk a little bit about gold. Seasonality. I got an interesting chart to show you, an intra month chart, seasonality on the S&P 500. I showed this, I believe it was in Wednesday's Trading Places Live over at Earnings Beats. I think it's a really impressive chart, something for you to really think about. So wanted to go through that again. Talk a little bit about Max Payne. It is option expiration week, and we had a great session at Earnings Beats with our members on Tuesday evening, and I'm going to go through a couple of charts there with you. Then we'll get into Earnings Spotlight. Had a number of companies reporting after the bell today. A couple of them I want to talk about. And then we will wrap up the show with 3 you must see. Pretty interesting trio of charts that I think you may enjoy taking a look at, maybe some trading candidates. Anyhow, I'm going to get into all that in just a minute. I do want to point you over to earningsbeats.com. Over on the left-hand side, you can sign up for our Earnings Beats Digest. It's a free newsletter. Comes out Mondays, Wednesdays, and Fridays in the morning before the market opens typically. Just simply type in your name, email address there, hit that subscribe button. We'll get you added. There is no credit card required. It is completely free, and you can unsubscribe at any time. But I think it provides some really good information, value, considering you don't have to pay anything for it. So check that out. Love to have you join our community there. Also, I want to point you to the performance of our portfolios. Our model portfolio starting to pull away from the S&P 500 again this quarter, currently up 15.31%. The S&P up almost 10 percentage points less, rising just 5.7%. Aggressive, well, you can see across the board, aggressive and income both slightly lower this quarter, but aggressive has a tremendous longer-term track record against the S&P. And then the strong AD portfolio, which is strong accumulation distribution, currently this quarter up 22% versus the S&P 500's 5.72. And you can see since inception, or excuse me, it's 24.73 versus 5.72. So it's almost what's about 19 percentage points higher. And then since inception, strong AD up 48.87%, S&P only 22%, so more than double there. The reason I bring all this up is that on Thursday afternoon at 5 o'clock, I will be announcing the 10 equal weighted stocks that are going to be going into each of these 4 portfolios. We do this every 90 days. It's really a marriage of buy and hold and trading. You got a little bit of both components, because once we put these stocks in the portfolio, we hold them 90 days. We hold them until we'll be getting in on November 19th. We will hold them until February 19th, at which time we will get rid of them and we'll go through this process again. That's what we've been doing now for 2 years on the model portfolio. And you can see the results. I think it speaks for itself here, plus 162% in 2 years, while the S&P 500 is up 33.6%. That's a lot of outperformance. It's almost 5 times the S&P 500. So we do release these stocks at 5 o'clock Thursday evening. I would strongly encourage you, if you've not been a member at Earnings Beats, join. It's $7, but it's fully refundable. So you join, you pay $7 within 5 to 10 business days. We'll refund you the $7, and you get 30-day trial. So it's a no-cost 30-day trial, and that includes coming to this webinar, all of our webinars, everything. So I think it's a great opportunity to see us in action, what we do, and I think you'll really enjoy it. And I think it may change the way you approach the market. All right, so definitely keep that in mind. We want to have you for that. Let's take a look at what happened in the market on Wednesday. Really saw some selling in the afternoon. Dow Jones Industrial Average down 345 points, a little bit more than 1%. But we did just break out to an all-time high, got up to that 30,000 psychological barrier that I talked about. And I think we just pulled back a little bit from it. That's all. Nothing horrible. The daily PPO looks very strong. So watch that rising 20-day moving average. If it does break a little bit below that, I think we got some pretty good gap support. So I think we could pull back. Again, it's option expiration week. We've had a big run. A lot of companies have in the money calls that you might see some of those wiped out this week and into early next week. So that's what I would be looking for. But at least technically, looking at the chart, I really like what's going on in the market. So the Dow, like I said, down 344 points. The S&P 500 down 42 points. The NASDAQ down 98 points. Which was a little less than 1%. So on a relative basis, holding up a little better. We haven't seen that breakout yet above that September high on the NASDAQ. We saw it on the S&P. We saw it on the Dow. We've seen a huge breakout on mid caps and small caps, even though they too pulled back on Wednesday. But all of these indices, in my opinion, look very strong. I expect we're going to see higher prices. But in the near term, wouldn't surprise me to see a pullback. And we'll talk about that a little bit later when we get into that Max Payne segment. Looking at the sectors, all 11 were down. So on a relative basis, industrials, that was the best sector. And this is a sector that I really like right now. Industrials are strengthening. Even though they were down the least of all of the sectors out there. And this is the group that I think is getting the most love in terms of all of the rotation that's taking place in the market. You might argue and say it's energy, and I can't really dispute that based on the percentage gain over the past couple of weeks. But let's not forget what happened to energy heading into this. I mean, we're just now trying to get back to where we were in August and still nowhere near the June high. Whereas when you look at the industrials, you can see this has been a consistent strengthening that's been going on in industrial. So yes, in the near term, I would agree. Energy's been a better performer. I don't know that that's going to last. And I don't know that I would trust it to last. I do trust the industrials, so I think this is going to be a good group going forward. And I'll be talking about that quite a bit in the top 10 stocks webinar that we have at 5 o'clock on Thursday afternoon. Utilities, very weak. Energy was the worst performer on Wednesday. Utilities, second worst performer. But they were both in uptrends. They're still both healthy. I would say on the utilities, you got a negative divergence. You got higher prices. You got a lower PPO. I wouldn't be surprised to see this come back down 62, 62 and a half. But I don't really think that's a problem technically. From an industry group perspective, autos, 2 days in a row now, big move. Really getting a lift from Tesla being added to the S&P 500. Also, NIO came out with its earnings, NIO. They were very solid. The stock gapped down, rallied back, filled the gap, and then went a little bit lower again into the close. But NIO still looks very good on its long-term chart. The worst performing industry group, your gold miners, broke down. I'm going to talking technically here in just a minute. I want to talk about the gold miners. I'm not a fan of gold miners. I've been saying this for a long time, and I'm talking about on a relative basis, not necessarily on an absolute basis, although you can see even on an absolute basis, we've been trending lower, but on a relative basis. And I'll point out some of the reasons why I don't like gold in just a minute. Let's move on to the 10-year Treasury yield. On Thursday, we do have a number of economic reports coming out. Initial jobless claims will be out 8:30 in the morning. The expectation there is for 710,000 new claims. Last week, 709,000. If you remember, we were really struggling for a while to get below 800,000. So we are bringing it down. Would be good news to see it go below 700, get that 6 handle. But we'll wait and see what happens in the morning there. November Philadelphia Fed Manufacturing Index. October's was 32.3, which was very robust. We are expected to pull back for November to 24.5, but that's still pretty solid reading. October existing home sales, the number there we're looking for 6,470,000 units. September was 6,540,000 units. So we're looking for a little bit of a pullback there. Although many of these home construction reports have been coming in ahead of expectations. We'll see if existing home sales follow suit. October leading indicators also be out in the morning, 10 a.m. The September gain was 0.7%. We're expecting the same thing in October, a rise of 0.7%. As far as the 10-year Treasury yield goes, you can see we're in an uptrend. I like the reversal and that bounce off the 20-day moving average today. I'd like to see that continue. I think that would bode well for the equity markets to resume their trend higher in time, even if we do pause temporarily. But any money going or any yield advance to the upside means that we're seeing some selling in treasuries. And even if that money doesn't go into the stock market right away, I think it'll sit in cash, and I think it eventually will find its way to the stock market. That's what I would be looking for. All right, let's move on. Talking technically, I want to talk about gold a little bit, because here is an absolute chart of gold. And I know, you look at this and you say, wow, look at the huge move in gold. And it has been a huge move in gold, no doubt about it. But I want you to take a look at the relative strength of gold versus the S&P 500. Yeah, we made a nice move in the first quarter of 2020. Outside of that, I mean, even during the advance in 2018, 2019, we just kind of going along for the ride with the S&P. It was not outperforming the S&P. So yes, it looked good. This first quarter, we did get a nice period of outperformance in gold. But look at what has happened since. Since March, we're trending lower. We're at about a 7-8 month relative low in gold right now. And I think the long-term trend, which in large part was due to a rising dollar, I think could still run into some problems. Before I take a look at what I'm thinking on the dollar, I want you to look at the gold correlation to the dollar. Over the last 10 years, I think it's pretty obvious that we have an inverse correlation. So gold and the dollar tend to go in opposite directions. When the dollar's rising, gold goes down. When the dollar's falling, gold goes up. That's the basic correlation between these two. That's what you should expect. And literally, as the dollar's been rising since 2011, gold has been falling for the most part, and certainly has been underperforming the S&P 500. Now, I'm beginning to get a little bit more bullish on the dollar. And I'm going to show you the 10, well, actually, this is a 15-year chart to help explain why. I look at the yields, the 10-year Treasury yields in the U.S. versus Germany, to kind of get a gauge on what the bond markets believe is the stronger economy. If the U.S. Treasury yield is performing better than the German Treasury yield, this spread will rise, the difference between the two will rise, and that has generally led to a rising dollar. If our economy is stronger than Germany's, our currency should strengthen, and that's what we see. Starting in 2018, though, you can see that this yield difference started to decline, even though the dollar kept going up. So what happened is we ran into this inverse correlation. Normally, we have positive correlation between the difference in the two countries' yields and the direction of the dollar. They tend to go in the same direction, and that's what this correlation tells us. But we do occasionally get into these periods where we have inverse correlation. Now, the first 3 times that it happened are all green shaded areas that I'm showing you, where the yields were going up, up, and up, but the dollar was going down. And in each of those 3 cases, the dollar came roaring back. Now, this one was a little bit different. The inverse correlation that we're seeing now occurred because of the dollar or the yield spread difference going down while the dollar kept going higher. And then the dollar came tumbling back down to play catch up. Now what I'm seeing, and I just circled it here, the blue circle, this is the difference in the yields, US and Germany. It's on the rise again. Now we've pulled back here just recently, say in the last few weeks, but overall this has been in an uptrend. Well, look at the dollar. The dollar continues downtrending. If this continues to break out and move higher, I believe at some point we're going to see this dollar shoot back up. And if we see the dollar shoot back up, all of a sudden, here's your inverse correlation where if the dollar's going up, gold doesn't do well. Now, I would even argue that since March, when you look at the dollar, here's the dollar index. Look at what's been happening since March. The dollar's been going down. Even with the dollar going straight down 10% in about 8 or 9 months, gold has been underperforming the S&P 500. That's with the dollar falling. What might happen if the dollar actually starts going up? I'm not a fan of gold. All right, moving on. Seasonality. I just want to point out a couple of stats here. I think really interesting stuff. S&P 500 performance since 1950, and these are the calendar months broken down: 26th to the 6th, 7th to the 10th, 11th to the 18th, and 19th to the 25th. You can see the 26th to the 6th. That's roughly 1/3 of every calendar month since 1950. That accounts for a lot, probably the equivalent of about, I don't know, 24 years worth of data. And the annualized return is over 20%, more than double the S&P 500's average annual return of 9%. Clearly, there's a bias in the market to go up higher from the 26th of the month through the 6th. Doesn't happen every month, so please don't quote me and say, Tom, you said that it's a guarantee that it goes higher. That is not what I'm saying. What I'm saying is it's a tendency. And so if you're a trader, if you buy and hold, or you hold long periods of time, this probably maybe you find it interesting, but it probably isn't going to change anything you do. If you're a trader, though, you need to be aware of these numbers. So when I look at the 19th to the 25th, by the way, Thursday is the 19th. So we're getting ready to go into this period for November. The annualized return is minus 8.69%. And those 7 trading days every month since 1950, that equates to about 16 years worth of trading data. So imagine going 16 years and losing 8.7% every year for 16 years. That would be a really rough 16 years in the stock market. That's essentially what we go through just by, not even knowing it. But the 19th to the 25th is very, very bearish. These are the red shaded areas, just to show you the last 3 months. This is an hourly chart. So there's the last 3 months during this period. Now, we're just heading into it now. I don't know what this red shaded area is going to look like over the next week. Maybe we go back down, test this area and bounce. Maybe we go sideways. Maybe we break down. If we lose gap support at about 35.10, 35.12, I think the S&P 500 in the short term could fall, and options would back me up. And so that's a good segue here. Let's move into the options and take a look. So I did a Max Payne webinar with our members at Earnings Beats on Tuesday evening. And we do this once a month. We always do it on the Tuesday before monthly options expire. Monthly options always expire on the 3rd Friday. So it's always the Tuesday before the 3rd Friday. We have these webinars. And so I just pointed out that the Max Payne, that's kind of the point at which all of the in the money put value equals all of the in the money call value. So call value and put value offset one another at this level. So if we're up here, that means there's a lot of net in the money call premium sitting on the table. Doesn't guarantee us that prices are going to go down, but I do tend to look at this as more of a directional clue. Kind of like if the PPO is breaking above the center line and pointing higher, it's telling us that momentum is to the upside. It's giving us a directional clue. I look at this for the same reason. If options was the only thing I considered, then I would probably be shorting right now, just because it's telling me that the odds are greater based on the options world that we're going to pull back. And sure enough, today we saw more than 1% drop in the S&P 500. Now, am I saying that I guarantee we're going to go to 334.69 on the spider? No, I'm not saying that at all. But the further it does go down, the least, or the less amount of in the money call premium that will be sitting on the table come Friday. And many in the money calls get exercised and people buy the stock. And so that's why some of this negative action can drag on into the week following options expiration, which in my opinion is why this 19th to the 25th number is what it is, because the stock market tends to go up into option expiration week. And then as we end option expiration week and then the week following, we tend to see the market weaken. That's the tendency. Very important. Tendency, not guarantee. But anyway, here's the S&P 500. Now I'll go through real quick and show you some of these charts that we looked at. So QQQ, not as far to go down to the downside. S&P was like 7% above Max Payne when we talked about it. The QQQ, which tracks the NASDAQ 100, was only about 3% or 3 and change above the max pain point. So not as far to fall there. I'll give you one long and one short here. Intel is a stock that's been beaten up. So there's been a lot of puts played on it. And so the max pain is actually above current price. So I'd be looking for potentially a rally. It did go down today. We'll see what happens the rest of the week. And then one that I'll give you on the downside was Boeing. Now, Boeing had good news on its 737 MAX plane, gapped up, opened at 223.02. That was the high of the day. Never went another penny higher. And pulled back, sold off $20. Last time I looked, it was down a couple bucks after hours. We'll see how it does tomorrow. But 173 is max pain. 173. Now, again, I'm not saying it's going to 173, but as it moves down, more and more of this in the money call premium evaporates. So many times it behooves market makers to see these reversals. And sometimes they put their capital to work and reverse them. That's a lot of volume on Boeing. I don't know if it was market makers, but I certainly wouldn't be shocked. Big reversal there on Boeing. All right, moving on. Let's talk a little bit about earnings. So first, I'll just point out NVIDIA. So NVIDIA came out with its earnings, very nice earnings, $2.91 versus $2.57. So an easy beat on the bottom line. The stock was down 2% after hours last time I looked. So, it's got equal highs, rising lows coming across here. I see an ascending triangle. I think this is a pretty nice looking chart. If you look, semiconductors continue to perform very well versus the S&P, and NVIDIA relative to semiconductors has been pretty strong, even though it has pulled back here over the past couple of weeks. I think it's just because it's consolidating. NVIDIA to me looks very strong. The AD line still very solid. The gap down with earnings may simply be an opportunity. There's a little bit more room to the downside. The ascending triangle trend line probably comes in a little bit above 500, maybe 510. Then you've got some couple price support levels, one at 500. The biggie for me is probably down closer to 475. Any of that could be tested in the short term, especially if the market's weak, but I would use it to accumulate. I actually like NVIDIA. Another stock I'll talk about here. Let me see what other ones we had. Jack in the Box actually came out. They were up 6.5% after hours. Looking at the chart, and they did have a great quarter, $1.61 bottom line versus a $1.14 estimate. But it's been going sideways for a while. The 6.5% gap up tomorrow, if it holds, would easily take us up into breakout territory. Jack in the Box, AD line's been flat for the last few months. Restaurants breaking out to a new high. Jack in the Box, fairly strong relative to the restaurant group, and it's not going to be hurt tomorrow based on its post-market after-hours action. The another one I wanted to point out, this one was not a good one, was ZTO. ZTO did beat by a penny, 23 cents versus 22 cents, but stock's down 6.5% after hours. So after starting to trend back to the upside, AD line looking pretty good. It's in business support services, which the group itself has been strengthening. But look at ZTO relative to business support services and relative to the S&P. Wall Street doesn't like it. Now, it did beat, like I said, by a penny. Was that enough? Well, in after hours action, apparently not. Stock again down 6.5% roughly. And that would be about $2, which would take it to about 30.5. So it looks like it's going to be down, challenging its moving averages, maybe between the two of them at the open tomorrow, and we'll see whether or not this trend line holds. But if it breaks back down below the 50, remember, it's been a relative laggard. This is not the stock that I would want to own in this group, simply based on the way it's been trading for the last 5 months. Forget about the earnings and the reaction. It just has not been a very good performer, so I'd be a little careful with it. The last one I want to bring you or show you here in earnings, and this one is going to be very interesting tomorrow. L Brands. The stock is up 15% after hours. Their expectation was to earn 6 cents. They earned $1.13. The stock is broken out. Look at the relative strength. Do you see the difference? This is a stock that Wall Street has been loving. This used to be a heavily shorted stock. I looked after hours. Their short percentage of float's down to 4%. It was 30 or 40%, maybe even higher than that, not that long ago, a few months ago. So shorts have been covering. Wall Street's been accumulating. AD line's been pretty strong, and we're going to get a gap up. So why is this going to be interesting? Well, if you go over to CBOE, you can get the options chain. And LB, this is for November options expiring on Friday. I want you to take a look at all of the in the money calls, starting all the way back at 1250. Now, obviously, we're not going back there, but this is still options that are going to have to be settled. You got a lot of options at 1250, a lot at 1750, 4,400 at 2750, 6,000 at 30. 3,600 at 34, 2,190 at 35, 1,600 at 36, 2,890 at 37, 8,200 at 39. After hours, this stock is trading at 38 and change. I just cannot see, with all of this in the money call interest, the stock going higher after it gaps up tomorrow. Maybe it will. It's going to require tremendous volume, because otherwise I think you're going to see market makers shorting the stock in the morning. It's going to be an interesting one to watch. How many puts do we have in the money? From above 38 and change, we have 2, 9, 2, and 1. We have a total of 14 puts versus thousands and thousands and thousands of calls. It behooves market makers to see this stock reverse on Thursday and into the balance of the week and maybe into next week. I would, if I owned it, knowing what I know, I would take my money at the open and I would run. And yes, it could go higher. I actually like the stock. Short term, there are inefficiencies in the market you need to be aware of. This is one of those. Again, no guarantees. I don't know that the stock's going to go lower, but I personally would take my money and run if I owned the stock and held it into earnings, just based on the option data. And if I owned options, I would get out of them on the long side. I would take my money and I would run, because it would behoove the market makers to reverse things here. All right, let's wrap this thing up with the 3 you must see. First one I want to go over is TripAdvisor. This one's starting to strengthen, starting to look pretty good here. AD line up near its highest level in about 7-8 months. It is struggling to get above $27, which was that June high. So that false breakout makes me a little bit nervous. I would expect maybe short-term pullback. I wouldn't be surprised to see the stock pull back to about 23, 23 and a half. So I do like the stock. It's coming off the bottom versus the internet group, starting to show some relative strength, nice volume coming in. But I think in the near term, you might get a little pullback and an opportunity to get in a little cheaper. That's what I would be looking for. Burlington, I think this one is beginning to resume strength. This is a stock that showed a lot of relative strength to apparel retailers in recent years, but it did struggle from its relative high back in June, and it's been downtrending. But I'm looking at the volume coming in. I see this gap up here, comes back down, holds the top of gap support. I don't know. I just think Burlington is starting to look good. Apparel retailers relative to the S&P, moving up to challenge about an 8 or 9 month relative high. I think this is an up and coming industry group. And Burlington moving up to challenge recent relative highs versus the S&P, and watch that September relative high versus its peers. If it breaks that, I think it would look really strong. And then the last one I have is United Health. It's just coming back down to test gap support. Here was the gap up, big heavy volume, went all the way up above 360. Now we're back down challenging the top part of the gap. We could see a bounce off that 20-day. That's what I'd be looking for. All right, again, big event on Thursday evening. I hope you all can make it. I really would like for you to join us. Come in. It's a $7 trial, but we'll refund you the $7. You'll get 30 days at zero cost, and that includes coming into our webinar. We'll be sending out room instructions to all of our members tomorrow afternoon. We'd love to have you, so please go to earningsbeats.com. Make sure you get signed up for that. Everybody have a great day, and I'll be back next week on Monday over at earningsbeats.com for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.